Uganda and IMF prepare for a new financial program. Uganda preparing for another round of for discussion with International Monetary Fund as the country looks at the possibility of securing new IMF supported financial program. The IMF is expected to send a staff team to Uganda in September 2026 to continue negotiation with Uganda government. The talk came at an important moment for Uganda. On one side, the country's economy is performing strongly with the growth being supported by domestic activity, construction, investment, and expectation surrounding that of oil productions. On the other side, Uganda facing growing fiscal pressure. The government debt has increased, debt servicing costs are putting pressure on the budget, and the country's fiscal position remains vulnerable. So why the Uganda considering a new IMF program? What does IMF want to Uganda to do? And could they expect start of oil production change Uganda financial situation? Let's look at close look. IMF to return to Uganda. The International Monetary Fund is planning to send a team to Uganda in September 2026. The purpose of this visit is to continue discussion about possible new financial support program for the country. According to IMF representative Uganda, previous discussions have been constructive, but additional programs needed before agreement can be finalized. This means Uganda has not yet secured new IMF programs. And both sides are still discussing what potential program could look like, including monetary, country economic policy, financing needs, and reform. Uganda previous IMF support program expired in July 2024. The new discussions therefore come after a period in which Uganda has been managing its finance without a new IMF blending arrangement. Why does Uganda need a new program? The key issue is Uganda's fiscal position. Uganda maintained relatively strong economic growth, but government finance have become more challenging. According to IMF 2020 assessment, Uganda overall budget deficit widened to about 6% of GDP 2024 up to 2025, compared with 4.7% in the previous fiscal year. Public debt also increased approximately 52.5% of GDP. This doesn't mean Uganda currently facing debt crisis. The IMF continues to assess Uganda public debt is sustainable. However, its classified country is facing modern risk of debt disaster, meaning the Uganda has less room to absorb major economic shocks than it would ideally have. The pressure is particularly significant because Uganda has become increasingly dependent on domestic borrowing, which has been relatively expensive. Debt servicing costs are the major concern. One of the biggest challenges facing Uganda is the cost servicing in its debt. When the government borrows money, it must take interest payment as well as repay the principal. As the debt increases, borrowing costs remain elevated. Large portion of government revenue can be directed toward the debt payment. That leaves less money available for areas such as education, healthcare, infrastructure, agriculture, energy, and social program. The IMF has therefore called for strong fiscal consolidations. Simple term, Uganda needs to improve the balance between the government revenue and spending while reducing unnecessary fiscal pressure. The IMF has specifically recommended strong domestic revenue collections and better control of current government expenditure. But Uganda economy is growing. Despite this challenge, Uganda economy outlook relatively strong. Really, GDP growth reached approximately 6.7% fiscally 2024-2025, according to the IMF. Inflation has also remained relatively contained, while the government foreign exchange reserve improved during 2025. The IMF expects economic activity to receive another major boost from the country's oil sector. Oil production currently expected to begin late 2026. This is one of the biggest developments shaping Uganda economic outlook. The oil factor. Uganda oil project has potential to transform country economy. Large investments have already been made in oil sector. oil sector, including infrastructure associated with East African crude oil pipeline. Once production and export begin, Uganda expected to receive additional government revenue. The IMF project at the start of oil production could push Uganda growth closer to double-digit level, fiscally 2026 up to 2026-27. The oil revenue also expected to improve Uganda's fiscal and external position over time. However, IMF warning Uganda not to trade future oil income as solution to every financial problem. Oil revenues need to be managed carefully. Why oil revenue must be managed carefully? Oil wealth can create major opportunity but also create economic problem if it is poorly managed. For Uganda, the challenge will be ensuring that oil income invested productively rather than being used to finance excessive recurring expenditure. Uganda already has framework for managing petroleum revenue. Under the existing fiscal framework, the only limited portion of the oil revenue can be transferred directly to government budget, while a remainder is intended to investments through the country petroleum revenue in the sovereign wealthy arrangement. The IMF supports maintaining the strong rules around the oil revenue management. The goal is to prevent Uganda from becoming too dependent on oil revenue and to ensure that some of will benefit future generations. What does IMF want to Uganda to do? IMF recommendation focus heavily on fiscal discipline. One priority is improving domestic revenue mobilizations. Uganda has significant potential to increase tax revenue by improving tax administration, reducing compliance gaps, and broadening the tax base. IMF also wants Uganda to control current spending. This would help create additional fiscal space and reduce pressure on government borrowing. Another important area is public financial management. Better budget planning and strong control can help prevent unexpected spending increase and improving effectiveness of government expenditure. Uganda debt is sustainable, but risk remains. This is an important for the revenue for understanding. IMF is not saying Uganda has become unable to repay its debt. Uganda debt is still considered sustainable under IMF baseline assessment. However, the country faces modern risk of debt distress. IMF debt analysis show that Uganda has limited room to absorb major shocks. For example, problems such as weaker export, higher global interest rate, delayed oil production, currency depreciations, weak economic growth could increase financial pressure. This is why the government is being encouraged to strengthen fiscal position may become major problem emerging. What if oil production is delayed? Another major risk is possibility to delay is Uganda oil production. The country economic projections are partially based on annual production beginning in late 2026. If the production delayed, the expected boost to economic growth and government revenue would also be postponed. IMF estimate that 1 year delay in oil production could shift the expected major increase in economic growth from fiscal year 2026 up to 2027 to fiscal year 2027 up to 2028. This demonstrates why Uganda cannot rely entirely on future oil revenue. The country needs a strong non-oil economy as well. What would a new IMF program mean for Uganda? A new IMF support program could provide several potential benefits. First, it could give Uganda access to additional financing. Second, it could strengthen investor confidence if the program demonstrates that Uganda implementing credible economic reform. Third, IMF support could help Uganda improve fiscal management and debt sustainability. However, IMF program can also involve policy commitments. This may include major relief to taxation, government spending, debt management, public financial management, economic reform. Therefore, negotiation will be important because Uganda will need to balance its financing needs with its own economic priorities. What happened next? Next major step in IMF submission expected in September 2026. During these sessions, IMF and the Uganda Authority are expected to examine Uganda economic conditions and determine what policy could support macroeconomic stability and sustainable growth. The talk will not necessarily result in immediate agreement. More negotiation may be required before a new program is finalized. For now, the September mission is an important step toward determining whether the Uganda and IMF reach new financing arrangement. What does that mean for East Africa? Uganda economic situation matter beyond its border. Uganda is an important economy in East Africa and they play a major role in regional trade, transportation, agriculture, and energy. Development also has regional implication because oil infrastructure connects Uganda with Tanzania. If Uganda successful begin to oil production while maintaining fiscal discipline, the country could experience strong economic growth, increasing foreign exchange earning. But debt pressure, increasing or oil revenue also poorly managed, Uganda would face great financial challenges. The outcome of IMF discussion will therefore be watched closely across the region. What do you think? Can Uganda use its expected oil revenue to reduce debt pressure and strengthen the economy? Or does the country need deeper fiscal reform before the oil boom begins? Share your opinion in the comment. For more East Africa business, finance, investment, economic news, subscribe the channel, turn on notification. Thank you for watching. See you next business reports.